Hey guys, this is going to be a quick video about the binomial tree model for pricing financial derivatives. If you haven't studied it before, I'll include some links in the description. But if you have, you might have been confused to hear people say things like this.
What I want to ask you right now is, what if I told you that instead of these probabilities, the probability of the stock going up was actually 0.1 and the probability of the stock going down was actually 0.9? In that case, what would the value of the option be? Well, using these new probabilities, straight away you'll see that there's actually no place to plug them into these equations. These values don't feature anywhere in our portfolio value in neither of these states, which means that these probabilities don't come into the equation in here, which means that they don't impact the option's value at all. Which is another way of saying that the growth rate of the stock has no impact on the option's price. Which is a little bit counterintuitive because obviously it does. I mean, what if the probabilities was, instead of 0.9, it was 0.999 and 0.001. In other words, the stock is almost guaranteed to go down. In that case, the option's price, the fair value, would still be 50 cents. And that's what's amazing about it, because in the binomial model, the growth rate of the stock has absolutely no impact on the option's value.
So it didn't make sense to me that the price of a call option on a stock had nothing to do with the probability that the stock was going to go up or down. So if the probability was 100% or 99.9999% to go up, the call option is the same price as if the probability that the stock was almost certain to go down or totally certain to go down. So that didn't make sense to me at all, because obviously if I believed that a stock was almost sure to go down, I wouldn't buy a call option. That call option would have virtually no value to me. If I was almost sure that that stock was going to go up, that call option would have quite a bit more value to me. So obviously the price of the call option does depend on whether the stock's going to go up or not. So I really felt like the entire conventional binomial model, tree model theory was flawed. And so I wrote a paper on it, and I'm going to include all of the pages of the paper, just 1 or 2 seconds each page at the end of this video so that it's on the video, but I'm also going to include it as a link under this video. So please take a look at it if you're interested. Essentially, what I believe they messed up on is the assumption of no arbitrage. They assume no arbitrage, and then out of the math, it naturally comes that the price must be independent of P, the probability that the underlying stock is going to go up. I think that assumption of no arbitrage is flawed, and if you don't assume no arbitrage, you get a model that converges to the old model, that converges to the old price in the case that you have no idea what P is, that your guess of P is a uniform distribution on the interval 0, 1. So it's kind of a mathy paper. If you're comfortable with math, though, you should be able to understand it. I encourage anyone who is interested in the binomial tree model and who had the same reservations as me to look into it. And, you might say, well, if your model differs from the old model, it's definitely going to create arbitrage opportunities. Yes, that is true. But the thing is, in order for my model to deviate from the old model, you would kind of have to know what P is. You would have to, in other words, be able to predict the market. And so, yes, arbitrage opportunities are going to be created in my model if people are able to predict the market, or to the extent that people are able to predict the market. But because people aren't generally able to predict the market, then those arbitrage opportunities are not going to occur. And essentially, if people are not able to predict the market, it just converges to the conventional pricing result. But essentially what the difference is they assume no arbitrage. My model assumes that the market is mostly unpredictable. And if the market is mostly unpredictable, you basically do not get much arbitrage, if any, and the prices converge to the old model. But it's not because the price is independent of P. If you were able to predict the market, you would then, yes, an arbitrage opportunity would be created for other people who can't predict the market, but an even bigger arbitrage opportunity is created for the person who's able to predict the market, because they're able to more accurately price the option, because the price does depend on what P is. And if you know what P is, if you're able to predict the market, you can make a lot of money because you're able to price that option more accurately using my new model. The old model would just give you the same price. Even if you're 100% that the stock was going to go up, the old model will give you the same price as if you thought it was 0% that the stock was going to go up, which makes no sense, again. And I give that example in my paper. So if you're interested, please take a look at the paper. Thank you. Okay, I just wanted to go over a few key parts of the paper. First of all, I'm going to switch the page to the page before this really quick, because the simplifying assumptions I make here, first of all, I'm working on generalizing these because I don't need to make all these simplifying assumptions. I was just trying to kind of contain the size of the paper, and I felt like if I could prove that the old model was wrong in one case where it's supposed to be true, then we can throw the old model out the door and start looking for a new model. And so I just kind of concentrated on one case that the old model is supposed to work for, and showed that it does not come up with the right conclusion. And in fact, I can offer a new model that gives a better pricing in this specific case. But I'm working on relaxing these assumptions, so don't let that hang you up. I'm just showing that the old model is at least wrong in this case, and in fact, it is wrong in all cases. And I'm coming out with a more general form of this paper. Okay, so now this part is important because I'm giving an example of a person who's able to completely predict the market, and I show that the old model prices it incorrectly in this case, and that's, you can see how short that is. It's pretty easy. Now, this part's important, the paradoxical risk premium section, because the old model comes up with this entire idea of risk neutrality. And let me explain how absurd risk neutrality is to you. So, risk neutrality assumes that I would, if I'm given two assets with the exact same expected return, but one is way riskier than the other one, I'm equally likely to invest in both, which is absurd. They have the exact same expected return in the long run, but one of them jumps around a whole bunch more and has a bunch more randomness built into it, where I could get super unlucky. Yeah, sure, I could get lucky, but I could also get unlucky. And so people, generally rational investors, opt for the sure thing. So let me give you an example of this. So let's say one of the assets was a 50-50 thing. 50% of the time I get $2 million, and 50% of the time I lose $1 million. Or there's another asset where I am absolutely guaranteed a risk-free return of $500,000 each time. I'm going to go for the one they both have, if you work them out, the same expected return, because it's 0.5 times 2 million plus 0.5 times negative 1 million, which works out to positive 500,000. So the expected return of the risky 50-50 asset is 500,000, and the expected return of the one that's a sure thing, 500,000, is obviously just 500,000. So they both have the same expected return, but one of them's way more risky. One of them I could lose $1 million. So 50% of the time. So obviously I'm not going to opt for that, and I'm going to pay less for that sort of risky asset. It's going to be worth less to me than the riskless return. But the risk neutral framework, that the entire model only works if people don't behave that way. That people must opt for they must be equally satisfied with a risky asset as they are with a riskless asset, which is absurd, and that's completely incorrect. So anyway, this just calculates what the risk premium would be. Assuming we're not in a risk neutral world and we're in the real world where people pay less for risky assets, it calculates what the old model would give for the risk premium. The risk premium is how, like, basically kind of how much you discount the price. So you can see it in this formula. The price of the option is equal to its expected value of the payoffs divided by something that's related to how variable those payoffs are, the riskiness of those payoffs. The risk premium tells you it's a conglomeration of the riskiness of the payoffs and my personal risk tolerance. Okay, so essentially if you calculate this risk premium, which comes from utility theory, and like this is ubiquitous in finance because it's a ubiquitously true thing that people prefer less risky payoffs to more risky payoffs. But if you calculate it, it comes out to this like straight line, which is not at all what it should look like. So what it should actually look like is this graph right here, which is what my new model gives. So I just calculate like what the variance of the payoffs are, and I come up with a new risk premium, and then I just like plug it back into this formula here to come up with the new model. And this is the new model, so that's the new result. And if you have a uniform distribution, it perfectly agrees with the old model. If you believe that the stock is almost sure to go up, so you think P is almost exactly 1, here you're 97.5% sure or more that the stock is going to go up. So you can see the deviation between the new pricing prices the option way higher than the old conventional model, because you're almost sure that the stock is going to go up, and we're talking about a call option here. So obviously a call option increases in value if the stock is going to increase in value. If you believe that, P is about 50-50, so there's still really good agreement with the conventional model. So even though this is an interesting case, because even though you're kind of sure about P, it doesn't really give you much predictive value over the market, because you're just predicting, I'm almost certain that P is around 50%. It's not going to be 30%. It's not going to be 80%. It's going to be somewhere around 50%. Well, you're pretty sure about P. This is a pretty narrow distribution on P, but you're not sure at all about which way the stock is going to go, because you're just predicting that it's a coin flip. So the lack of predictive power there means that the new model that I've come up with converges essentially to the old model. There's like a little bit of deviation because you are cutting out like some of the, like a call option doesn't have much downside because its payoff is like the flat line, and then it goes up linearly after you cross the strike price. But so when you create a narrow distribution like this, you're cutting off the downside and the upside. But the thing is, with the call option, there's not much downside, and so you're not cutting off as much downside as you are cutting off the upside potential. So my new model will be slightly less than will price it slightly less than the old model, because essentially the narrowing of the distribution from a uniform just kind of asymmetrically cuts off more downside than upside. Or sorry, it asymmetrically cuts off more upside than downside, simply because a call option starts with not that much downside to begin with. Okay, and here's where I explain what arbitrage looks like. Actually, here I have a very interesting sentence. If the buyer of the option knows that the underlying stock is going to go up, P is equal to 1 for him, then him and the seller of the option can both benefit, can both simultaneously profit from perceived arbitrage opportunities, because this guy has what I call a P-dependent arbitrage opportunity. He knows that P is 100%, that the stock is definitely going to go up. So he's priced the option higher, and he's able to buy it in this scenario. He's priced it at $25. He's able to buy it at I think let's say that they agree on $13 for the option. So he's able to buy the option for $13 even though he's priced it at $25. but he's priced it at 25 only because he's sure that the stock is going to go up. So that's what I call a P-dependent arbitrage. He's able to, for sure, get a profit of $12 in his eyes because he's sure that the stock is going to go up. The other guy isn't sure that the stock is going to go up. The other guy might not have any clue what the stock is going to do, so he's priced it at the conventional price of $11.11. I worked out this example earlier, but so they both think that they're benefiting off of arbitrage opportunities. The seller thinks he's got a $1.89 arbitrage opportunity. The buyer has a $12 arbitrage opportunity. So they're both simultaneously profiting from arbitrage opportunities, except the buyer's is what I call P-dependent arbitrage, and the seller's is a P-independent arbitrage, kind of the classical arbitrage that they're talking about when they make the no arbitrage assumption. Okay, so, and it's weird that they're able to simultaneously benefit from them because they're on opposite sides of the same option trade. And each believes that the other has mispriced the option. So it's kind of counterintuitive. It almost reminds you of special relativity a little bit. The different observers with different kind of reference frames, different beliefs about what P are, they see the world differently, and they both say that the other's wrong about kind of measuring the meter stick. But they're actually both right simultaneously because they're both right in their own frames. So, if you didn't know what P was, you would be correct to price the option near $11.11. But if you do know what P is, you're not correct to price it at $11.11. And that's where my new model differs from the old. Okay, and then why arbitrage does not occur? Essentially because people can't predict the market. So there's not going to be that many people that are predicting what P is with any type of accuracy. And if you can't predict what P is with any type of accuracy, it converges on the old result. And so almost everyone in the market will price it similar to the conventional result, and therefore there won't be any arbitrage opportunities. Okay, so that's most of the paper. And then I just wanted to scroll down here to these graphs. So this is just kind of showing that, it agrees. It's not just a uniform distribution. It's any sufficiently broad distribution. If you're really unsure about P, you're going to price it at the conventional pricing. And even if you are fairly certain about P, that it's, you're kind of bullish on it, you think there's a 60% chance of the stock going up, it's not like a huge deviation from the old pricing. But, if you're 60% sure that the price is going to go up, that's pretty awesome predictive power. If you're actually accurate about this, if you're right about it, that's awesome predictive power, and you would be able to benefit from pricing the option more accurately because you have more information than other people. Other people who don't have the information that you do will price it correctly along the orange line because they won't know what P is. But if you're some savvy investor and you got some sweet model that's able to predict the market, you are going to be able to make money off of that, and you're going to be able to price it more accurately. The old model won't price it more accurately for you because it's completely P independent, which is wrong. My new model does take P into account, and you would be able to price it more accurately given your predictive ability. And then this is if you're bearish on the stock. You can see that the gap's bigger here. I kind of explained that in this last paragraph, but that's basically because of the asymmetry of the call option, that it's got more upside than it does downside. So anyway, if you're interested, please read the paper. Thank you.